Hello and thanks for tuning in. Today, we're going to dive into the core classification of a specific financial service, Beforepay. Understanding whether a service like Beforepay functions as a loan or a wage advance is crucial for consumers looking to manage their personal finances effectively. This distinction has implications for how it's regulated, the associated costs, and the user's overall financial health. Beforepay operates on a model that allows users to access a portion of their earned wages before their scheduled payday. Users connect their bank account, and the service estimates their expected income. They can then cash out a predetermined amount, which is capped based on this estimation. This amount is typically repaid automatically from the user's next incoming salary deposit. This immediate access to already earned funds is the cornerstone of its operation. The key debate centers on the fee structure and the mechanism of repayment. Beforepay charges a fixed transaction fee, rather than interest. Because the service is tied directly to the user's earned but unpaid wages, and the repayment is generally automatic and linked to the next paycheck, many argue it aligns more closely with a cash advance or wage advance service. It is a way to bridge the gap until the contractual payment date for work already completed. However, from a legal and regulatory standpoint, the line can sometimes blur. Traditional loans involve borrowing money with a commitment to repay, often with interest, over a set term. While Beforepay does not charge interest, the transfer of funds and the fixed repayment obligation can share characteristics with a short-term, small-sum loan. Regulatory bodies in various jurisdictions are still working to clearly define and categorize these emerging pay-on-demand services, often looking at the effective annual percentage rate, APR, implied by the fees to determine if they should be subject to stricter lending laws. Ultimately, Beforepay is best described as a wage advance service or pay-on-demand platform. While it carries the core function of advancing money that must be repaid, the direct link to earned wages and the fixed fee structure differentiate it significantly from traditional payday loans or installment loans. Consumers should focus on understanding the fixed fee in relation to the amount advanced and how often they use the service to accurately assess its total cost.